right, everybody, welcome to the digital asset experience here at the Borgata in Atlantic City. Excited to have everybody here. We have a very interesting panel today. As you can see from the name of the panel, we took every buzzword we could find and we put it on the panel title. So, in order to try to hone in a little bit more on what we're going to talk about today, I do want to start with a question to the audience. Now, we got about maybe 40 or 50 people here. Who here in this audience, just raise your hand, right? This is very simple. Who here has heard of Bitcoin? Okay. Everyone. Okay. Second question. Who here over the past year has had a client or somebody they work with or maybe or your business has been involved in digital assets or has exposure to digital assets? Raise your hand. Okay. It's like 90%. Right. So as you can see, that's why we're here today and that's why you all listen, right? Public companies are no longer asking whether they could hold digital assets. They're asking how. Okay. They're doing that right now because there's a major paradigm shift occurring in the way that we raise capital and the way that the market is structuring capital raising. Tokenization will create a new way of raising money, which includes easier access to capital, more liquidity, decentralization from a pricing perspective, and automation within compliance to reduce costs and make things more efficient in the public. Today's discussion is going to talk about the how. How do we create a digital asset strategy? How do you ensure that you have proper control, governance, and when you're making critical judgments in your business, how do we ensure that you're making the right one? Those will be explored today on this panel. This is not about crypto speculation. This is about a new reality that is intersecting with the legacy. All right, my name is Steve Baum. I'm the co-leader of CBiz Crypto. CBiz Crypto is a division, the crypto and blockchain division of CBiz. By background, I'm an auditor. I focus the majority of my career on auditing public companies, bringing them to the public markets through IPOs, reverse mergers, and other areas in the technology sector. And 2015, I got into digital assets. I've been in crypto now for about 10 years. 2015, founded the crypto practice at a firm called Friedman. It was later acquired by Markham and now acquired by CBiz recently about a year ago. I focus primarily on nationalizing digital practice at CBiz across the entire country. CBiz is the number 7th largest company in the world. For those who don't know, we're the only publicly traded stock on New York Stock Exchange, so that's pretty cool. But besides that, we primarily focus on serving the capital markets and serving crypto and digital asset businesses that want to enter the capital markets by giving them good, high-quality accounting services. Today on the panel, we have Mark Eckerly from Witham. We have Alfred, I didn't get his last name.
Alfred Blair Blakey III.
Okay, and Jason Bashar. I'm going to have each one of them go down, give them their intros so you can hear what they do, and then we'll start asking some questions.
Awesome. Thank you, everyone, for coming out today. Mark Eckerly, very similar to Steve. I'm a partner at Witham Smith & Brown. We are a top 20 public accounting firm. I'm primarily working in our technology and emerging growth services practice, and nestled under that group is our digital asset division. I'm the firm's team leader of that practice. We go to market, audit, advisory, tax work, so kind of very similar to Steve and at CBiz, working with public companies, private companies, kind of understanding their digital asset business operations, what makes them unique, and what makes them different. So thanks, everyone, for coming out.
Good morning, everyone. Alfred Blair Blakey III. I've been on Wall Street for over 33 years now. Most importantly, now I'm a partner at Money Channel, and I'm the founder of a company called DataVault. DataVault is a tokenizing digital asset company. We wrote all the patents. We were first to do so back in 2017. So we have a precedence on everybody. And our patents are litigation grade. And we've been looking at monetizing digital assets and real world assets on a platform that the world could take advantage of. And looking at alternative investments that we're talking about here, these guys are setting the regulatory path and making sure that you move in the right direction as you're starting to tokenize. So we'll talk about that later on. And thank you two guys for setting the precedence in a bigger company to say it's okay to do this. It's all right to do this because there's an opportunity for all of us to take all of that data that the shareholders should be taking advantage of, okay, and now start to put that to work, which was just worthless till now.
I'm Jason Bishara, Financial Lines Practice Leader, NSI Insurance Group. We are a global risk management firm. We are the fifth largest independent insurance agency in the United States. We operate in all 50 states and 100 plus countries. As the Financial Lines Practice Leader, I drive our capital markets practice. So we focus on ensuring publicly traded companies, venture capital-backed companies, or private equity group portfolio companies and family offices. So we're really focused on the management liability portion, although we'll do the operational risk and employee benefits. We look at providing outsourced risk management solutions to publicly traded companies that cannot afford an in-house risk manager.
All right. So we have, a good breadth here of different experiences in the digital asset sector. So, I was talking to a lot of people at the conference the last day or two, and people really want to know right now, how do we implement either a digital asset strategy today, or how do we actually get exposure to it in a compliant way? So we're going to start. The primary thing that a lot of people probably in this room have seen is the digital asset treasury business. Okay. So I want to start there. To talk to that as topic number one, the DAT, how to ensure that if you're looking at a DAT or you're getting involved in a digital asset strategy, you are asking the right questions. And then two, we're going to go in a little bit more with Alfred is how is the market structure of raising capital completely changing right now? And how is that going to impact you? So the first question is from Mark on the DATs. Where are the areas that you typically see when a company is doing a merger, or let's say going public with this strategy? Where are the areas that potentially could cause delays in the capital raising or the deal from an accounting perspective?
Yeah, there's really two areas that we focus on as auditors, right? When we come in working with attorneys, it's the getting a company audit compliant, PCAOB ready if they're going public, cleaning up those back audits and understanding a lot of the accounting disclosures, the implications, as well as the control environment, which I think will parlay nicely into what Jason has here. But when you think of the back audits, get a company audit ready, and a lot of the implications that can come with what a digital asset company has from an audit perspective. It's really wrapping your head around fair value. What's the valuation? What's the policy? Working with management to figure out how they're going to get to that conclusion. A lot of it is what's the business case? What makes your company unique. It's funny, I've been in the space for about 10 years now, and every year it's kind of a new wave of something within the crypto world, right? We had the NFT phase, and 2025 is really focused on this digital asset treasury. And the first question I would ask companies is, what makes you unique, right? Gone are the days of, we have a Bitcoin treasury play, because that's been done, that's tried and true, right? So what makes you different in the market that will differentiate you to your competitors? So starting there and then kind of diving further into what are the underlying risks and assertions that we have to understand on the asset that you're working with, right? So if it's a new token, if there's a foundation, understanding some of the complexities wrapped around that. A big thing that we spend a lot of our time on is wallet hygiene and the corporate governance around that, making sure the proper controls are in place. So for folks that are looking to invest and understand businesses, I think that's kind of priority number one is what is the uniqueness with that token, what makes it different to its competitors, and then two, what's the control environment around that token? What's the governance that a company will have in place? Just to make sure whether you're going to do self-custody, qualified custodian, understanding the difference between hot and cold wallets, because each company will have a unique strategy from that perspective. But Jason, I'd be curious to get your thoughts, kind of parlaying the risk world when we're trying to attack that and understand it from an accounting perspective. What does that look like when you're looking at companies?
I appreciate that. So what we're seeing a lot happening in the marketplace are a lot of, most recently, and I'd say the last 6 months of are being done with that strategies are companies that are using the strategy as a means of raising capital, but there's not a clear direction in the business strategy. And because there's not a real clear direction in the business strategy, there's sometimes miscommunication with the marketplace, which creates liability because after a company creates a dilution event and then the stock trades off, we can see litigation that can occur. So communicating properly with your shareholder base and understanding what the future of the business is, or having a true business model and not just using it as a vehicle just to raise capital, and also depending on what type of asset you're really using. If you're using Bitcoin or Ethereum or a lesser token, right? There is a difference in what you're going to see from a liability standpoint. So when you look at, and I'm actually going to punt this over to Alfred, because Data Vault, from what I understand about Data Vault, there's a true business model behind the structure. There's a lot of value to it.
Yes, that's the token. The utility token that we've patented, okay, is not a Bitcoin piece. You can have things tied to strategies such as that, but the utility token is what the company has in the digital asset. We are partnered with IBM at Data Vault, and IBM Watson X does our data score and our data value. So they set the real-time price of your digital asset, your real-world asset. And having IBM as a partner is a trusted partner. It's almost like using Bitcoin instead of using a lesser token, so to speak. So we have a high-grade set of partners that surround us that are multi-billion-dollar companies that set that strategy forth where it's compliant, where it's trustworthy. So, for example, a company that has failed biotech data, all right? And we'll get into other things after this. But that failed biotech data, there's no ROI on that. For the investor that invested in that 2 years ago before the trial started. If you tokenize that trial, okay, or now if the trial's over and you want to get something from that trial, you can tokenize the failed biotech data. IBM gives it a score and a value of where it was done, how it was done. And another company could take advantage of using that data to not make those same mistakes, or to pivot from that to do something that's faster, better, and they're saving a lot of money for their shareholders as well. That's just a small example of the biotech that we've started. We're partnered with the NASDAQ. The NYIAX has a partnership that we have an exclusive license that we're allowed to trade these tokens on the NASDAQ platform at Data Vault. So you have IBM doing the data value, data score. You have Clear, like in the airport, doing the KYC. Your other partner that we have is a company called Houlihan Lokey, another multi-billion-dollar company. They're writing the smart contracts. Token is really a smart contract behind it. And the smart contract gives you the rules, the regulations on that token, and it allows everybody, as the token trades, to get remunerated for what participation they put into it.
Can I jump in there real quick? So ultimately, the value from a risk management or risk mitigation standpoint, there's a clear path and business strategy to the capital that was raised in the business, and not just we're going to earn interest. You're just going to, move forward as like an investment vehicle or an investment company. So having a clear vision that you're able to communicate, if you're going to use these strategies, I'm saying this from an insurance standpoint, if you're going to use these strategies as a means of raising capital, have a path of monetizing the business and not just using it on a debt strategy will mitigate your risk completely. And of course, larger companies that are using it as balance sheet diversification, that's a totally different story. They have to put it on their balance sheet. That's a totally different type of transaction. But from a governance standpoint, I'm sure Mark has some comments.
I was going to just jump in really quickly because I think that'll bring it full circle on understanding the tokenomics, right? If it's a utility token versus a standard investment, it's understanding how to parlay that onto a balance sheet, right? What's the value from an investor standpoint? And what's that going to look like on a company's financial statement, right? Is it going to be a fair valued instrument? Understanding how to properly fair value those tokens. And then the other side is if it doesn't kind of fall under the fair value standards, how to fully understand the value of a company when the balance sheet doesn't reflect the true operations or financial position, because some tokens don't really fall under the fair value criteria. So it's kind of an addendum, right, under non-US GAAP standards to understand that a company does have some liquidity that it can go to market with even though it may not be reflective on its balance sheet. So from an investor perspective, it's understanding those nuances for digital asset companies as opposed to a TradFi company.
Yeah, so just to try to, I would say, bring this together, I think when we're thinking about the data set that occurred over this past year, I think what everyone's saying here is that's kind of phase one of this massive integration into infrastructure and into tokenization. And the key to assessing businesses for success is going to be about the execution of that long-term vision and how they're going to leverage the digital asset that's in their books or on their balance sheet to figure out how they're going to use that in an operational business in the future to actually create cash flow, not just to sit on an asset to create staking yield or to create interest, as Jason had said. And the one thing I would like to highlight there that was said a little bit by Jason, but the biggest risk I see is that these are going to be similar to any startup businesses that need execution risk. But when you look at the businesses, a lot, for me, I read a lot because we work with a ton of them. And if the disclosures are talking about, hey, buy this token because it's the best token out there, and it's the top 10 token, and it has all the things, it actually could create more risk for you as an officer or as somebody doing the deal, because that is a lot of speculative information that ends up going to the providers. So be more clear about exactly what the strategy is and less about speculation just because the top 10 tokens, what does that even really mean?
What? Just really quick. So I think a lot of it is that next thing. We saw a lot of this during the ICO boom. We're going to promise all these cool, great things on the surface, and then there's no execution underlying it. So it's basically just the next phase within the crypto wave. What's that going to look like for corporate governance perspective?
I was just going to say it gets really dangerous when you look at, from a disclosure standpoint or communication standpoint, you have an unregulated industry of crypto, and then you have a regulated industry of publicly traded vehicles, and then you have these operating entities that are operating clearly to the governance rules, guidelines, and guidance, and then you bring in people from the crypto world who are communicating in a completely different manner, and they get extremely aggressive, and it creates a lot of liability and volatility in the individual stocks, which brings exposure to the people who are actually running and operating the entity.
Well, that's why the tokenomics is here. So the token ties to the company, ties to what the company is doing, ties to the value of what they're doing, and it's an alternative way behind the smart contract of execution. So the token and what the goal is for what it just started at Data Vault, the NIL, Sports Illustrated NIL. We're going to trade NIL on the NASDAQ. And that value of each individual player, team, whatever comes up onto the NIL is going to have the value of from the player. The smart contracts go, the school get paid, the player get paid, and the NCAA get paid. Everybody's going to get paid off of that smart contract. So the structure's there. Okay, and what type of regulatory agency do you go to if you're doing commodities? Different type of token, securitized token. You have to go through that agency and really look at the criteria and put the token. As far as securing wallets and everything else, we have a Web3. Web3 can take away the security opportunities that could somebody's wallet or anything else. That Web3 environment that you see is only Web3. And using Web3, the assets are in the safe. And they can't get hacked. And you're only as good as the security system behind who's holding the digital asset for you. Web3 can be evaluation, an opportunity to monitor security.
Okay, as the insurance person on the panel, the thing that I'm learning really quickly is you want really good legal counsel and really good auditors.
So, question for you, Jason. As an auditor, as we start to move away from centralized, historically, trust had the ability to centralize. To moving into decentralized finance. Talks about, how do you use counterparty risk when you're no longer working with a counterpart. You're working with an autonomous smart contract. How does insurance
The thing about the insurance companies right now, and specifically these strategies, they're trying to risk, right? Which is the reason why when these strategies first started being introduced, premiums were a tenth of what they are right now, and capacity has shrunk. So people doing these strategies, the insurance premiums are going through the roof. Because until more insurance carriers come in and understand how to actually underwrite the risk, the very long story on that is they're figuring it out now.
3 minutes, please,
It's historically, this has been going on for years. Google's been taking everybody's data, selling it behind their backs. There's no insurance problem with Google or anybody else. It's been Uber. Any of these companies, Facebook, that's how they got there. They got to their presence of being so big by taking other people's data and using it in a way that wasn't transparent to everybody. Now that it's become transparent to everybody, you have to audit it, you have to insure it.
But will it be transparent? I don't know, right? So, I mean, obviously we've seen this.
It's going to be transparent. Blockchain and tokenization.
Blockchain will be, but will data be transparent? I don't know. I mean, obviously we're seeing major movements occur on chain with like Anton Network, if people follow that, where that network specifically is that big institutions and banks do not want their information to be public. So we're seeing this shift too, where blockchain as a technology will win. We know that, right? We know that the technology is better than what we're doing. There's no doubt. But how we use it, how different institutions use it, is going to be fundamentally different across the board. So that's where we're sitting. And I think Google, even with that, getting data, there's a lot of issues for a very long time of how they store your information. Obviously, Europe has the GDPR issues and different things about personal identification. So we're seeing that, and we're trending a line between not just securities and commodities regulation, but data regulation and personal identity theft. That's why there's not contract, because it's like, who owned that? You know, who wrote it? Who deployed it?
And you'll know from the start of that contract because it will continue to trade. And as the person that started that contract, as that contract trades, that person gets remunerated every time it trades. So the person, so it always ledgers back to the creator of that contract, like Emmett Smith, some big well-known name. They start trading token and something that has value or later net that comes down and that goes up for sale. And that's great. Your house gets paid. You know, it's goes back. The ledger like the Old Testament, all the way back. And that person's name and likeness now is there for life. For there. He's not here. Michael Jordan makes money every single year off them. Just because Jersey Owens passed away, his name, image, and likeness. If you look at his estate, who was more of an impact, Jersey Owens or Michael Jordan? You know, it's safe to say his estate's not doing as well as Michael Jordan did. So that smart contract will go back to Jersey Owens and his estate or his estate for life.
So, Mark, this question's for you. Obviously, one of the major risks associated with bringing a company public in the digital asset space is getting an audit done. So as we enter into these smart contracts, on-chain activity, talk about how do we audit?
Yeah, the audit process is definitely evolving, right? It's not traditional, like you said. It's moving away from reliance on third-party institutions and figuring out how, from an audit perspective, we can get comfortable with verifying the immutable ledger, right? Understanding blockchain technology, its capabilities, and placing reliance on that. Trying to pull as many sources together as we can to corroborate that information and that data. But it's definitely throwing a wrinkle into the traditional audit process, similar to what Jason was mentioning, right? And placing that reliance. We're adapting, we're learning, especially as new tokens and new chains are launched. Each one is different and unique, like you mentioned before, right? So trying to wrap our heads around the tokenomics and understand, right? You're never going to see an audit report or stock report for the Bitcoin blockchain like that. No one would do that, right? So it's just figure out ways to craft your audit process, make sure you're covering your bases and understanding what are the true risks for a company, right? You're going to promise all these glitz and glams and they're going to deliver on this token. But let's boil it down to what it's actually going to deliver and what's its true purpose is. And let's figure out how to build our audit approach around that. So it's a lot of just understanding companies, talking to management, talking to the board, right? All the folks that got invested and put the time, blood, sweat, and tears into it, that we can have a full understanding and full picture of what this company's doing and what's the go-forward vision.
Yeah, I mean, I think, you know, as an auditor as well, both Mark and I have been auditing crypto for close to 10 years. And what we're starting to see shift is that the blockchain is becoming more real than anything else. So this is happening in actual today, right now. You talk about the ability to rely on information, an external piece of information as an auditor. What is that piece of information you're relying on? I could rely on the Bitcoin blockchain, or I can rely on a bank statement coming from a local small bank in Minneapolis. What's more reliable?
It's funny that we mentioned that, right? Because you can, in real time, at any point you want, you can see transactions happening in real time for digital asset companies. And it's trying to juggle that balance of reliance on a technology versus I've gotten audit confirmations that are wrong and IOU that are human errors. So it's funny to figure out that that's the highest level of assurance from investors, from auditors, but there's also the possibility that that could be incorrect.
Right. You don't count audit procedure. Our audit procedure is send the confirmation to a bank, sends an IOU, and you say, okay. You know there. You can do multiple levels of procedure from existing, rights and obligations, valuation. I mean, there's that makes it more auditable and more read than the things that we store at the read.
The next step is RWA, real world asset. And a lot of mining companies that are here are starting to understand that they can tokenize assets in the ground. Okay, we can cut out the national debt by pre-selling 10% of the copper in Arizona, the gold in California. You know, and you're doing that with the assets that are in the ground with small percentages. You tokenize a small percentage of, but it has to be proven, like you said. So you have to have that data score come in and say, okay, this third party said that they did this many drills, they did that many drills into the land, and that's what we know to be in that land. So we're going to tokenize a future of that gold. Okay, that's the mining fee, and IBM scores it, values it, then you can start trading the token. That the token's going to trade as gold trade. But every token that trades, remember, in the smart contract, the company itself makes their own little bit. They're trade gold. So now these real world assets that are accountable, that are verifiable, are going to be the first to really go before that digital asset. That is worth.
So, you know, we'll talk about this now. Moving on to, let's say, tokenization and RWAs, right? You know, the way that capital is raised right now is so focused on centralized parties, getting a banker, getting an underwriter, doing all these essentially manual people. The ability to do this on chain is going to create unreal efficiency. So, Alfred, tell us about how you see kind of the new market envision and like how capital is going to be raised with market.
Well, we're going to start to cut out cashless ones. We're going to start to cut out banks taking a little bit of advantage of the small fry out there. And this is the way it's done. It's got to be that way. It doesn't have. You can use tokenization to help your shareholders in a way that are there now. And by raising the assets to the company, the growth and everything else, like the real world assets in the ground. There's the silver in the ground. And it's trade as the hard items. You guys have some sort of verification of that. You know, I don't even want to get into what quantum computing is going to bring to everybody else, because that's going to make a lot of dust. We don't have enough time for that. But the IBM outlet of that scoring data and valuing it gives you it's almost like using a certain encyclopedia, okay, instead of using something that's just in the newspaper, so to speak. It gives it more validity. You know, it gives it all validity about the support that is valuing the data, securitizing the data around the value of that. And when it gets on the marketplace, it trades. Look at all these stocks that trade out of control. They're, oh, this is an AI company that's 10 years ahead of its time. It's trading the marketplace, the NASDAQ preferably, because I'm talking data vault, the marketplace will take it to where it wants to go. The marketplace will set the value of it. But you need to have a real value to start with. If you have a real value, put it into the marketplace and let's see what the market does.
Go to Jason on this now. Like, it's interesting because obviously using the blockchain to raise capital in a decentralized manner is going to create more transparency for everybody, for price discovery, to determine what's going on in the market. But, the whole reason you have the SEC, you have finance to create a level of compliance, so you don't have insider trading, you don't have things going on. So when you think about this, Jason, from like, all right, we're going to be on the blockchain to raise capital and price discovery could occur decentralized without all these counterparties, how do you mitigate risk there to ensure that there's no...
That is the main question, right? So I guess the answer is if somebody wants to conduct fraud, ultimately, insurance policies right? So you want to do mitigate the risk. You want to make sure the insurance policies that you have are properly mitigating the risk that you do have. It's like even now we're starting to see the policies that are coming out with crypto exclusions or blockchain exclusions. Certain carriers are just completely, they're not underwriting at all, right? So you need to pay attention if you're using any of those strategies. You may have those exclusions or loss or theft of crypto is not going to be included in the prime policy and it's going to be completely excluded out unless you find one carrier that actually does it for loss or theft. So the question is, how do you mitigate against some of these things that are occurring? The answer is a very strong risk management plan. Review, we call an insurance coverage review. Analyze your policies. Right? Have a third-party independent review of those policies. So if you're currently working with your current broker or any risk manager, what you want to be able to do is take it out of the third party and say, hey, analyze the policy. Make sure we don't have any gaps. Make sure we don't have any exclusions that we're not aware of. And provide that back to us so that the board can actually analyze it and then associate that with cost. And then that business cost, you can make a determination. Again, a lot of these companies we're talking about, very small, don't have very strong balance sheets. So it's very hard to say, all right, we're going to turn around and go spend $5 million on insurance.
And that's what keeps these people in the same position here with having to do that other banking. I believe that the smart contract will mitigate a lot of what you're talking about. The insurance companies will move over to the smart contract and start seeing what the smart contract has in it as a basis of best insurance. The insurance companies look at your smart contract. You don't need all these people to do this. You pick from a library.
Is it audited? Who controls the contract? I think
that's where we need you guys to say you're going to be making this smart contract. You're going to be helping develop smart contracts, and then you just pull out the back of the office.
You're talking about how we're saying
quicker, fast.
Yeah, but it's not just that. It's skill sets. So what you're saying is you have to count those in charge of like that. You're having computer.
No, contract writers. Smart contract writers. And law firms can do that too. They write the smart contracts, and now you choose which one you're going to use.
Contracts today.
That's why we use Houlihan Lokey.
But the value of data and the value of clean data, verified data, it's paramount in any industry that all of us are in, including the one that's not so. So it's going to change. It's going to AI and blockchain. Obviously, everybody already knows this. It's radically transformed. It's not going to. It's already radically transforming the worlds that we're in. From the insurance world, things that I'm seeing from a technology standpoint, I said on a couple of different advisory panels and whatnot, companies developing technologies that are going to transform how underwriting in the back end of the insurance industry is working, functioning, and operating. So a lot of these things from a validating standpoint, smart contract, when you're able to validate that data in a manner that's able to digest it, it's very big. I don't even know how to do it.
Okay, maybe create information as a decision maker. I can make a judgment.
So that's why IBM would score that for you. If you have data that biotech data coming here, you need a data score to validate the data value or to validate the truth, so to speak, behind the data that's coming. So that data score, where it's coming from, management, all these other things that an AI model could do to help the score. You get a score, and you'll say, okay, I'll take the risk on this score because it's coming from here. So all these data points is where it came from. IBM, the founding father of technology in our country, I believe, is doing their solid fact, and the others will follow as well. But the thing is that with data, the thing is we have the patents.
We have about 10 minutes. More questions about value. I want to hear first. I kind of want to hear Alpha because
he's good.
My question is going to be, how do you value assets on a chain where there might be integrations with smart contracts or NFTs or something else behind just the token? And I want to hear your perspective on value. Like, how does an investor look at that and say, what is it? And then I want to hear Mark's perspective on how you would determine it.
Okay, so when we're talking about the value of the data or the real world asset, okay, there's so many different ways that an auditor or somebody else is valuing this before a company comes public. What's the valuation? But then that valuation, the minute it all that becomes dust in the sand. So it's the initializing valuation and then letting the marketplace take that. Sometimes the marketplace is less ignorant. Sometimes they're or more ignorant, where they're just trading based on buzz, or they're trading on forward-looking statements and everything else. But it's the auditor's process to set the tone, set the value, okay, and set what should be set. And then it goes to the marketplace. The market takes over. So basically, in trying to value digital assets and everything else, a mosquito data in Florida could be worthless. All of a sudden, ecobytes. That mosquito data is like a YouTube pop. They're valuing, put it to the NIH for sale. So there's different the way news comes out so fast. The way things trend. If you set that value with the auditor right from the start, where that is, it's like a growth company. Sometimes it won't show the growth in the marketplace, and then sometimes it will show that this is too trending and it's trading overbound.
Well, I was going to say it's twofold, I think, because if you go back a couple of years, right, trying to figure out the value of NFTs, right, the fair value of NFTs. Each one was unique in and of itself, right? So you're trying to figure out, okay, recent sales, those that had similar properties, and trying to find almost what would be a weighted average analysis of that NFT, right? So from an audit perspective, it's trying to wrap our heads around that. And then when you get to the real world assets and it's supporting a token, it's a little bit more tangible and definable, where you can look back gold. Easy example, like you mentioned earlier, Alfred. That's easy to
real estate.
Yeah, it's pegged to that. But when you're getting to maybe more luxury goods, fine art, or
wine, a barrel of wine, fractionize a bottle of wine and buy that wine in the barrel for the future of, and something goes wrong in the weather, that asset value will change for that barrel of wine that you're fractionalizing. Now you sell some stock, go buy that token on the NASDAQ.
So as I say, from a valuation perspective, you'd almost want to rely on an auditor, on an appraisal, third party coming in and doing a valuation, or you could also look at what that tells you, the mosquito data, right? What is that trading for today? What is someone willing to pay for? Right? You got to put some reliance on that, because if there's a market for something, I think that's a very credible source. Someone's willing to pay $10, not that I would do it, but that's got value too, right? So if it's retail, you're putting some credit to that.
Buyer's remorse. Everybody's got buyer's remorse after they go out and have a great dinner. You know?
It's hard to these types of transactions because we see it a lot. It's who is the other side of the transaction. Well, so related party deals, things like that. It's very hard to track some of this, especially with the way blockchain is anonymous. So it's hard to know. Okay, well, maybe
Is there somebody scamming? You're right.
Somebody priced this, and it's just really them on the other side. Or
arm's length
it's
transaction.
It's hard to know in the security place who the naked short is as well. It's hard to do. So it's this. Everybody shouldn't be scared of this. You should be jumping in, and you should be looking at the alternative of what your stock's been doing. If you're a CEO, what your company's been doing, and if you look at the 5-year high of it, and it's $3,000 because you had to rinse, wash, and reuse. And what about that first shareholder who owns it at $3,000? Where's his remuneration? There's nothing there for him except a fractional ownership of stock that had to dilute itself because the marketplace didn't give it what it really deserved. Tokenizing will give it what it deserves. And IBM will tell you what the starting price of that is. Whether it falls out of favor, IBM will always have that underlying value of what the asset is.
All right, we have about 5 minutes, so I'm going to do a rapid fire here, and then we're going to do Q&A. So just really quick, starting at Jason and coming down, one thing that you believe will be the biggest impact in digital assets in the next 12 months, or trend that has the most, I would say, runway or upside. And
Just because it's directly in my wheelhouse and I'm already seeing it because of demand letters, but I think we're going to see a lot of litigation and a lot of the transactions that have come by, especially with DeFi. Now, we don't know what's going to happen. But DeFi being the first one that has come out, depending on what the outcome is of that, is probably going to determine what happens with the rest of the marketplace. And that will also have an impact on whether or not these deals, the smaller deals, continue to have that type of traction and it becomes more of just a balancing diversification.
I'm talking about real world assets. The real world asset exchange is going to be the most explosive thing coming onto the marketplace that you've ever seen. An alternative way for companies to raise money that have real assets and to use the tokenization process, okay, to cut the litigation, to cut all of that out and make it an apparent transaction for the company, to the investor, and all different types of investors. Not just certain type of people get to have this investment. It's only for institutions here. The tokenization makes it for everybody to take advantage at the same time as Mr. Jones and Mr. Smith. Everybody has an equal playing field with real world assets and tokenizing them and trading them, basically, let's say, on the NASDAQ platform.
That's exactly where I'm going. I think we picked it up at the beginning, right? It's one of those buzzwords. We've been talking about it for years, right? What is tokenization? And I think now that we have a more friendly regulatory environment under the new administration, we saw a lot of clarity come out in the digital asset space in 2025. So I think in 2026, you're going to see some companies start to execute on that tokenization play. I was working with a company that tokenized their equity, right? So now shareholders, you mentioned anyone, right? Not just accredited investors, but anyone can now own a company's equity. And it's very seamless from their wallet, right? So you don't have to go through your brokerage. So I think we're going to see more use cases of what that looks and feels like for retailers like us that are trading, whether it's tokenizing a real world asset, tokenizing your personal medical information, whatever your PII is. So I think that's going to start to come to market because that's been a buzzword for years now, but we haven't seen any execution on that front.
Yeah, I mean, I think on that side, tokenized funds is happening now. We saw it with BlackRock. They did their build fund. We've seen it with Franklin Templeton. They did their fund as well, which is representing U.S. money markets. And what those are actually doing is they're taking the underlying fund and putting it on the blockchain by allowing you to basically receive rewards in the form of dividends in the form of a digital asset to your wallet in real time. So I'm not talking about like, hey, let me wait for every quarter to get my payment of my interest or my dividend and make sure that I'm holding it for a period of time to get that. You're accruing every second you're accruing a piece of interest into your wallet. And that's what Franklin Templeton's doing with one of their products. And BlackRock Build product is also like that, very similar. But I'll take stablecoins. No one said it. I think stablecoins is going to be massive. I saw today Fidelity take their own stablecoin. I mean, this is a concept with stablecoins that it is an application. This is going to be, in my opinion, the most used application in the entire world will be stablecoins, because at some point, like, everybody in this room's kids will not know what cash is. They will not hold it. They will not use it. They will believe that what is on their phone and in their Venmo or on their stablecoin or whatever application they're using, that's real to them, not paper that we float around. I think that is going to happen. My partner speaks at NYU regularly, and he always asks the same question, and the hands keep getting less. The question is, who in this room is writing a check? And nobody knows. Insane. So that's where we're going. So with that, I think I'll end it with saying, look, this is no different than the traditional finance system we are in now. It is just a better way to do it. That is what everybody on this panel is saying. The products are the same. Everything is the same. We are just making it better. And that's why people will ultimately use this technology. So we will pass it on to anybody in the audience who wants to ask questions. I don't know how, or I think there's somebody back here with a microphone. Please raise your hand, and we will do our best to respond. Danny B.
Yeah, I got a question. It's been robbing around on, what this thing's supposed to be about, which is raising money. And you're right. A lot of these issuers are doing deals with cashless foreign, and their shares are trading as huge. Shares, I wouldn't mind. Shares will be an issue. Even the ones online are tokenized, or at least on the blockchain. So we know that they're not being held 10 or 20 or 50 or 100 percent. The market. So it doesn't go to pump through. And immediately going to 50 cents. And then you're battling every day to get it back to $1. And NASDAQ. Which way you guys are going to do?
Tokenization will cut that out. Tokenization will cut that out. You'll be raising money through the tokenomics, and there's not going to be a cashless token. Okay, the token's going to be exactly what you're paying for it. You're going to understand it better. You're not going to be able to loan out the stock from the authorized shares outstanding. So there's authorized shares that are given out too. And people use that as a locate for a short, so they can keep on shorting. Okay, the deal flow comes out, and they know that there's warrants. They know those warrants are going to the Bahamas somewhere, or they know something's happening, and you can tell by the volume coming in that people are lending the stock over and over from the loan or whatever it is that the bank is using, and their clients that are buying or raising money for your deal, the companies behind it, the funds behind it. Okay, they're the ones out there trading it off, not Wainwright. It's their clients.
I understand that. My point is, why is that? How is that?
I think it's a regulatory matter right now.
That's a regulatory
It's a regulatory issue. I think they need clarity on understanding where they fall. So you can't just start creating technology and integrating the historical legacy system without clear framework. So what's going on in Washington with the Clarity Act? I mean, nobody can agree right now on what's going to occur. And I think that's part of why innovation hasn't happened yet, because you don't want to build a product that if the legislation comes out after, you have to change your entire product. I mean, that's terrible deployment of capital.
And the token. I mean, shares should be thinking about the exchange. That's the OTC and NASDAQ. Okay. By calculation, what's the and what's the ratio between the token and
I mean, the token and the security, what's the difference, or how will they work together?
Yeah, linkage. Let's say.
You know, I have a good question. We're speaking to clearinghouses as well as having your Web3 wallet, okay, in your brokerage. So you have your brokerage and your Web3 wallet.
Yeah, it's coming.
That's together. So now I got a Web3 wallet, a token, and it's being now use my portfolio as an real world asset. I said I'm going to be buying this wine because the weather's going. I can use my money to use to buy tokens, to buy securities. And if there's something crazy going on in that area that I don't know, I'll stay away from that part of the industry. And I'll go to something that I know and have access to the world doing.
That's coming. That is coming. The delay with the interaction with the wallets in my mind is track that information. Right now for accounting purposes.
So Keith isn't that involved.
I don't. We should do business.
That's a question. What you're talking about, all the problems that you face in the market, because you're the cheapest one. Okay, and blockchain tokenization bring T0 settlement. Okay, means that's the biggest. Having a T0, you know exactly where your stock is at the second, at the minute. You cannot play 24 hours with your that becomes you got to get it. Well, that's it. The blockchain can have less limits at 415. That's all the fucking
That's a great thing to bring up. T0 is blockchain. T0 is zero latency. How do you stop hacking?
And to go back to the gentleman's previous question, what's the difference between a token and security, right? When you have that digital representation of the underlying security, there is that T0 capability, so you're not relying on the 930 to 430 window for security, right? So you own the security of the underlying digital representation, and you're free to do with it what you will.
All right, we're off the hook. So we appreciate everybody's time today. And, thank you very much for listening.
Thank you.
Who do you want? Who you gonna be tonight? Who is it real? Make it up your mind. You wanna listen to the man? Pay attention to the magistrate. And while I got you in the mood.